Just now, I haven't had him on the channel for a while, and it's good to see Kenneth back. Kenneth, how you been, my friend? Long time no see. You've been busy counting money, looks like. New fund, bull market. You've not been coming on the show.
Nothing much, nothing much. It's been quiet all around, and markets do help. Like I heard you say it some time back, it's a reasonably good economy to be in at this, and I think it will sustain itself for a couple of quarters, if not a couple of years.
ये तो पहली बार है that fund managers are listening to television anchors.
Well, it works both ways sometimes.
Okay. So, in general, what do you make of this sudden turn in liquidity? Because for me, that really is the story of 2023. The way foreign institutional investors, our good old fair weather friends, who after selling and massively selling down in 2022 have made a roaring comeback. Do you think this is just the beginning of a multi-year turn when it comes to global money allocations to India?
So India has always been on the radar for a long period of time. Okay, and India's been sometimes a strategic trade and sometimes a long-term trade by foreigners. I think given where the economy is based and given lack of also options that are there available across the world, we will get a fair share of the larger allocations that are there. So I think what you see right now could be sustainable. But I don't understand their compulsions as to why they take money out and why they bring it. Of course, a lot has to do with what's happening in their home markets at various points in time. So they did take money off, and you saw what happened and you saw reasons why that emerged. I think a lot of those reasons have quietened down quite a bit, quite significantly. So you're back to the trade where emerging markets are getting back into their allocations, and India is one of the larger countries out there.
Though to turn contra in the market, because what we've seen is while the market optically may be at life highs, but a large gamut of heavyweights, so to speak, have not participated at all in the move.
Well, if you look at the marketplace, we're just about close to where we were in 2021. So there's been a fairly long consolidation that has taken place, right? And if you look at all companies that are there in the indices and also some of the top 500 companies in these indices, they are not cheap in terms of where valuations stand. So they are about 20 times to 25 times earnings. But while saying 20 to 25 times earnings, they are also at their best in terms of where their financials can be. Okay, so you're coming out of an environment where you have reasonably close to peak margins, peak profitability, and lowest debt on balance sheet. Okay, so to expect the same companies to do it all over again at this base, I think a lot of companies have the problem, and these are the large companies have a problem of reinvesting their capital on the ground, right? So I think that's where the challenges are. The big companies are struggling to reinvest capital. There's not enough opportunities on the ground to leverage the cycle forward, which is why I think, given valuations fair, inability to invest capital into larger projects, they will tend to be a little, should I say, cash flow yield kind of valuations rather than growth valuations.
Kenneth, I'm going to take the clock back. We had a conversation around financials, and you've said that, look, I don't like financials. And financials have done rather well for themselves. When we spoke to you that time, the cycle was different, interest rates were different. Now the cycle is different, interest rates are different. How are you approaching financials as a category? Because given the weightage of financials in a benchmark, it's hard for any fund manager to ignore it.
Okay, firstly, what's there in the benchmark has very little relevance to us, right? Because when we put money to work, we try to optimize return on capital employed of companies, irrespective of which industries they are in, right? And somewhere financials, or should I say a breadth of financials didn't fit the entire portfolio. Now, if you look at this, the environment where it is today, now, so just let me give you a statistic. I think the Nifty 500 companies, which is approximately 30% of our GDP, right? Their total debt on balance sheet, net debt on balance sheet, would be in the region of about 25 lakh crores, right? And our largest bank that is sitting there, which is the public sector State Bank of India, their total balance sheet size is about 55 lakh crores, right? So, so corporate India is under leveraged and they can't grow because they lack the opportunity to actually put in significantly large projects out there. And I think that's what the problem remains with the banking system, or I would say generally in all corporates. And so banks are available at some of the banks are available at nice valuations. Some of them are growing, but I think it's a stock pickers market rather than saying that financials is great. Okay, number 1, 2, 3, 4 probably did well. After that, it's a wide open basket, and it's really a stock pickers market. So indices wise, the banks have done well, but within those indices, you probably have 3 or 4 banks that have done extremely well, and they are the ones with the largest weightage in the index. Okay, so our views, you go stock picking there rather than try and own financials as an asset, financials as a basket, and you will come out okay.
I'm again looking at the Bloomberg data, what is available in the public domain, all cap strategy, one of your biggest schemes. There is, it's a very stock specific theme there. You've got Reddington, you've got Aurobindo Pharma, you've got Radico, you've got Tata Steel, you've got Global Spirits, and you've got IX. So I can only see that as a theme there is liquor, and as a play there are metals. Let's understand, why do you like liquor? I mean, I'm not talking about liquor stocks. I'm not talking about any personal habits here, Kenneth. Only liquor stocks we are discussing. Let's me qualify it with a disclosure upfront. It's Monday morning.
So it's very stock specific. It's got nothing to do with the category. I think both those companies came in our portfolio when they were trading at low single digit kind of multiples, and the opportunity and the execution of both of them were extremely good. Okay, one is a manufacturer which has got tailwinds of ethanol, and the other one was premiumizing at a pace that we haven't seen in the past before. So I think that's where the two businesses came in, and they have been long-term holdings right now. So what you see right now is probably, I mean, in the case of Radico, it's been around for the last 5 years. In the case of globus, it's been around for the last 3 years. But I've known both these companies since almost a decade or two, ever since they were listed. So it's got nothing to do with a category. They're just about simple execution businesses that are there. And when it comes to metals, I think we come through the hump of balance sheet stress that is there on commodities. So I wouldn't say metals really, but commodities. And if commodities are this solvent and throwing out this kind of cash flow, I think they've got to be valued at a very different level over a period of time. So I think that's our context of holding these two businesses on the ground.
There is a sugar rush in the entire AI space, and Nvidia is one example of what is happening to the US technology sector. What happens in US market normally translates into a trend in India and into emerging markets. Now that AI is the go-to space for everybody, chip manufacturing is the space where everybody wants to have their presence. As a fund manager in India, what is the best way an Indian can bet on this entire multi-trillion-dollar AI theme?
I think you just sit back and watch, and then in the second round, pick up the companies that will survive the cycle. And that's how we look at it. We really are pressurized into catching the next big best thing, and I think that's been our strategy. So we are very old school. We do not take a risk on something that we don't know how it will emerge. So we sit back and and in the second cycle, you will get companies which are large companies where valuations are great. But right now, I don't think we're going to chase some of those names or any of those names.
Interesting as well that Sam Altman on our network exclusive did say that to a certain extent AI may be replacing jobs, but of course not completely. What's your outlook then, Kenneth, when it comes to the entire earnings season that has gone by? Is there anything that has stood out?
Hmm. Yes, plenty actually. It was difficult to find a company that lost money. I think that's a significant takeaway from last quarter, from FY 2024-23 numbers. And even if you strip out the digital businesses, there were even fewer companies that made money. So I think that's a very good place to be in. Like in the last newsletter we had wrote to our investors, we said that India's got a problem of too much of equity today. In 2015, you step back to 2015, and India had too much of debt on the balance sheet. Today, we've got too much of equity on the balance sheet. So the good thing is, it's a super environment to be in. The negative part of this entire cycle is if you don't find too much of investment opportunities, then it will be a drag on our ROEs or our capital efficiency. So either India has got to pay out a lot of dividends, find opportunities to invest, or your ROEs are going down to a secular decline. So that's one takeaway. On the flip side, and that's the important piece to look at. Find an industry which is over leveraged anywhere in the world, okay, and find an Indian company that is under leveraged, okay, and that's a sweet spot to be in. Now, there is one space out there which is effectively pharmaceuticals, right, and that also in generic pharmaceuticals. If you look at most of the US companies out there, they are over leveraged. Some of them are already filing for bankruptcies. If you look at the Indian companies catering to that part of the world, they are cash on balance sheet. Now, I know it's not the best trade to be in, and it's not the most favorite trade to be in, but this seems to be something like IT businesses that were there in 2006, 7, 8. Right? The US companies got over leveraged in services, and the Indian companies went and took market share. So I think that's a very simple trade that's playing out, and that's how Indian corporates can use their balance sheets to go out and get a larger part of the global market share or global trade.
Okay, Kenneth, great to have you on the show today. Thank you so much for taking the time out and joining in with your thoughts.
Thank you very much.
Well, here's a programming note: unlock a golden opportunity